Yo, what's going on, guys? I'm actually going over three dividend stocks that pay you out monthly. So once you buy them, you'll get the monthly cash flow for the rest of your life. And these dividend stocks are truly passive income because if you ask people who own houses and tenants, it's not actually passive income, but these dividend stocks are the real definition of true passive income. So I hope you'll join me today as we go over three monthly paying dividend stocks. And I've also carefully selected these so they can easily afford their dividend and raise it. So let's actually dig right into it. And the first stock I wanted to show you guys is actually ticker symbol MAIN or Main Street Capital. And look at the actual stock price. Anyone who's ever bought this stock is up on their position. And if you include the dividends, you're definitely up on your position. And right now, it's actually yielding 7%. So even at these really high stock prices, you can still get a 7% dividend yield. And they actually sometimes make so much money that they pay out multiple times in 1 month. Like, look right here. You got paid basically 3 times in 1 month. And why do they do these monthly distributions? Why do they do this? It's actually because they have to by law. So Main Street Capital, capital implies it is a BDC, and BDCs have to by law pay out 90% of their taxable income in the form of dividends to the shareholders. So it's kind of like REITs. But anyway, they actually just reported earnings in the most recent quarter, a couple days ago. So we're actually going to look, how did they do in their most recent earnings report? Can they afford the dividend? All right, so now let's dig into the financials. And remember, they pay 23 cents a month every single quarter. That's less than $1. That's all we need to remember. The dividend cost them less than $1 per share. But anyway, let's actually look at their numbers. So here's their net income. Hey, it's up year over year by 86%. Here's their total revenue. So their total revenues are growing. But for BDCs, we actually want to look at the actual operating income. So it's $82 million in the most recent quarter. I also wanted to show you their balance sheet. Look how their leverage ratio went from 52% to 46% while gaining more assets. So that's a really good sign. So remember, $82 million. How much does their dividend cost from that? It actually only cost them $71 million in line with the 90% rule. And remember, their dividend costs less than $1 per quarter. And here's how much they're making per quarter in normalized diluted EPS. This is what I like to look at over the normal EPS because this includes all the factors that you wouldn't in EPS that you should. So look, $1.25 in the most recent quarter. And of course, they can easily afford that. That's why they're doing these special dividends. They're making so much money per share that they can afford to pay it out. So that's why I really like Main Street Capital. And how much cash do they have on hand? So hey, $77 million. Hey, it looks like that's up from, that looks like the most they've ever been. So, hey, they're chilling on a ton of cash. So, even with these high dividends, they can still retain enough cash to have a healthy balance sheet, which I really like because look, 46% assets to liability ratio down from 1 year ago. That's a really good sign, like I said. So, this one, in my opinion, is a super safe monthly paying dividend stock that I think you can collect monthly cash flows for the rest of your life with this one. I don't see it going anywhere. Of course, nothing in this video is financial advice. Do your own research. And hey, also make sure you hit the like button. I forgot to mention that. If you're enjoying the video and like how I show you all the numbers, I really would appreciate if you'd hit the like button. But yeah, let's actually dig into the next monthly paying dividend stock, which is actually ticker symbol EPR or EPR Properties. Now, this one is a REIT. And just like BDCs, like the stock we just looked at, they have to pay out 90% of their taxable income. So they have these really high dividend yields and they pay out monthly. So yeah, EPR Properties is yielding 7.32%. So that's a very attractive yield. Let's see if they can afford it. So remember, this one is a REIT. And we'll actually look at their dividend history. So, one thing I will point out, which some people might not like, is that they don't have dividend growth. They've been keeping it at 27 cents, but hey, who can complain about an over 7% dividend yield? 7.32%. So, that's a really good dividend yield that I think all investors would be happy with. But anyway, here's their net income. Remember, for REITs, we don't want to look at net income or anything like this. We actually want to look at the operating cash flow because this is also known as their core FFO. And this is what they pay out the dividend from. And it's a really good sign to see that it's up 12.5% from 1 year ago. So $149 million. Let's zoom out. Yeah, so it looks like that's the highest it's ever been on average. What are their assets versus liabilities doing? It's at the same assets. So look, their assets haven't changed from 1 year ago. Yet it looks like they're getting more profitable because they made a lot more money than they did 1 year ago without losing or gaining any assets. So let's actually dig more into it. So remember, they made $149 million in core FFO and their dividend literally only cost them $68 million. So in my opinion, they have room to grow it. Like they just literally do. We can look at their normalized diluted EPS. This looks really good, 89 cents in the most recent quarter. And REITs really like to dilute the shareholder. Let's see if they're doing that. So actually, wow, you haven't been diluted, only 0.41% year over year. That actually makes sense because they haven't grown assets. If they wanted to grow assets, they would issue more shares. And it looks like they haven't done that. And they haven't needed to because they can still grow their numbers 12% year over year without having to issue any shares and gain new capital. And why would they when they can already easily afford this and basically for the rest of time, as long as they can keep the numbers how they are, they'll be able to raise the dividend to like 10% and they can still easily afford that. So yeah, that's EPR Properties. Let me know your thoughts on this one. It is a smaller market cap, $3.4 billion. So hey, it could be a little bit risky, but hey, there's risk with every stock. And we looked at the numbers. In my opinion, they're in a very healthy position and can easily afford the dividends. So yeah, let's actually go and look at our last stock. Yo, real quick, if you're wondering what app I'm using to analyze all these stocks with, it's actually called Webull. And if you go in the description and use my code and download the app, we'll both actually get 20 free fractional shares. So hey, just a little way to help out the channel. And if you want to actually get the app, because it's a great app. But anyway, let's actually dig into the next stock. All right, guys. So this next one isn't a stock, but rather an ETF. And I'm going to try and convince you why this ETF will do insane and you'll get some insane dividend returns. I actually own this ETF in my Moo portfolio, but right now they're yielding 18.25%. Okay. But the dividend also stagnates and changes every single month. Like, let me actually show you the history. Remember, this is a monthly payer. You get paid on the 9th of every month. So sometimes it's 40 cents, sometimes it's 50 cents, sometimes it's even 20 cents. So, hey, it always stagnates. Let me show you the assets under management's growth. So, look at how many retail investors or just people that are investing into this ETF. They now have $646 million of assets under management. So it looks like a lot of people are buying this ETF right now. So what is this ETF and how do they afford the dividend? Well, it is a covered call ETF. If you're familiar with JEPI or QYLD, you would know exactly how this works. But this one actually follows an index known as ticker symbol TLT. And remember, both of these ETFs are owned by BlackRock. And look, doesn't it look just like the ETF? The ETF actually is less volatile because it has the covered call strategy, but it actually follows this stock right here. And this is, of course, the US 20-year Treasury bond tracks it exactly. And what a lot of people don't know about bonds is the bonds actually depreciate. So from 2020, you lock in your dividend yield, but then the actual bond depreciates. But now it's at a very attractive price where right now, if you buy bonds, you not only lock in the dividend yield, but you also get the capital appreciation. So as soon as the Fed hints and says that they're done raising interest rates, as soon as they say that and it's confirmed, this will never be at these prices again. The stock price right now is at the same level it was in 2006. So let's say you bought it right now and it went back to where it was in 2021. It would go from $88 where it is right now to 140, and that's, almost a double. And guess what? If you buy TLTW and TLT keeps going down, you won't lose as much money because it's a covered call ETF strategy. And you also get the monthly cash flow of the dividend to also help the losses. And when it goes up like crazy, when interest rates are done going up, you're going to be thanking yourself that you bought this ETF because you just locked in an insane dividend yield, and the stock will never go back to those levels. I mean, unless the interest rates go back up, which if they go down, it's very unlikely that they're going to go back up because that would show some uncertainty and they don't have confidence in themselves. But anyway, guys, thank you so much for watching. I really would appreciate if you'd hit the join member button. YouTube just approved me for that. If you want to support me, all money I make from this YouTube channel, no matter what, all money I make will be invested into my Moo stock portfolio. But seriously, thank you so much for watching. Make sure you check out my video up here on AGNC on why it's not a good monthly paying dividend stock. It's another popular monthly paying dividend stock that I recommend you don't buy, and you should go see why. But anyway, thank you so much for watching.